Welcome back to my channel. I'm the Cover Call Guy, and today we're going to be talking about why you should stop listening to all the BS. And this is examples of um, the BS from like Seeking Alpha, Morningstar, TradingView, StockTwits, Tip Ranks, Benzinga, and just a whole bunch of other stuff. The reason I mention this is because this is from personal experience. I used to always be constantly trying to get as much information from everywhere and anyone, right? And that's terrible, especially for new investors, because you're just going to end up clouding your own judgment, especially if you're just trying to learn to invest, right? Learn from good sources, solid foundation sources where you learn the basics of understandings, the definitions of understandings, how investing works, right? Not from all these stock tips or what you should do, what you could do, all these recommendations. Those would actually make you a worse investor, in my opinion. It at least made me a worse investor. Um, it just put me into so many different directions that it completely threw me off track. Before we get started, the legal disclaimer: this content is for information on educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making financial decisions. I am just some random idiot you found online, and I could be completely wrong. With that out the way, let's get started on today's video. And it's gonna be, stop listening to all the BS, all that noise, right? Seeking Alpha has all these articles, whether it's good or bad. Especially if you're a new investor, or you're somewhat new, right? I would say less than 3 years of investing. Some of these sites are great to look at the financial side of it, the actual solid data. But other than that, a lot of these articles from these websites are just, they're just pushing out articles. They want you to subscribe. They want you to pay. They're trying to entice you, and that is what is going to really derail your momentum. Because once you start reading on this, then you start um, doubting yourself, and that's when it really harms you. Coming from personal experience, right? I used to use Seeking Alpha a lot. I used to use StockTwits a lot. Um, um, Market Watch, I would read the Monty Fool, Morningstar. Like, all of these are great to an extent, but don't ever just always take them as at face value, right? Some people actually deep dive into it, and I'm like, you don't need to. A lot of these people write these articles to get paid. They don't care about whether you make money or not, right? They're just writing articles so they can get paid, they can get views, they can get clicks. You would actually always question their motive. And to my conclusion, I think it's all BS. Use their site to read the financials, but that's about it. Always try to stay away from the echo chambers. All right, man, let's get started. This is a nice quote from Benjamin Graham, one of the greatest of all times. The investor's chief problem, and even his worst enemy, is likely to be himself. Why? Because you are going to be your own worst enemy when it comes to listening to your own opinion or listen to others people's opinions without actually doing your due diligence and actually fact checking yourself, right? Don't listen to other people just because other people are listening to them. The information paradox, right? More data could mean worse outcomes, and that's what happens to me. This is my personal experience, and I just want people to see my story and what happened to me, and possibly what's happening to you right now. The illusion of understanding, right? This comes from the FINRA study. The study quantified that this disconnect: 64% of investors rated the knowledge highly, yet those confident investors answered fewer questions correctly on a knowledge test. Right, 76% of investors use high risk margin could not correctly answer a factual question about it. And then you have the performative nature. Platforms like StockTwits and Twitter, of now X, incentivize users to share anecdotal wins while omitting losses, right? You see that all the time. You always see people posting the wins, the screenshots, but when it comes to red days like today, November 13th, where the entire NASDAQ, S&P, crypto all just dropped, nobody ever be like, hey man, I'm still winning. They're quiet. You ever notice that? They're quiet, right? There's Declaration of success mislead others, inflating the overconfidence and priming them for ill-informed reactive decisions. Especially if you ever come across someone who has a Patreon, or they're trying to sell you, click a link, sell a course, or subscription. That should automatically throw you into a red flag mode. Like, he's obviously, or they're obviously trying to just have you pay for something, right? I mean, they don't have your best interest. If they were truly trying to help you, it would be for free. It would be for free. Why would you need to have someone pay you, be like, all right, now you unlock the 50%, more knowledge of this and this. Now you can actually make more wins. It's all BS. The human machine paradox. Financial news and sentiment data now, right? Oh, it's like all AI. For those who don't know, like, AI are actually like spitting out and writing out these articles and news. It's all algorithm. Algorithm can process data dispassionately to achieve better prediction accuracy. It's just dumping out data on these some of these slop articles, and it's like false. There's just so much mistakes to it. And then for humans, the same information is toxic. The human brain is a biased latent narrative engine, not a rational processor, right? News activates emotion, recency, and fear. So if you're just reading and sticking to the what the news source is saying, one, it's probably going to be fairly outdated, or going to be outdated, right? It's old news, hours old or days old. You could be reading and getting information from a reporter who knows nothing about the topic, but they're just reporting it. And then the casual proof, right? An actual foundational study proved this. A constant stream of news caused human investors to fare worse than the control group that received no news at all. Rather have no news, which is good news, than getting so much news and you end up taking it all as bad news. And then that completely just messes with your psyche, and then it just completely throws you off. The behavior gap, right? Empirical proof of degraded performance. What this just means that trading is hazardous to your wealth. A study in 2000 of 66,465 household found a catastrophic negative 6.5 annual underperformance for the most active traders. The cause was not poor stock selection, but the act of trading itself, right? Basically, these people were constantly like listening to other people, following the herd, and basically trading based on the news, what others are doing. I mean, obviously, I made a video about this. Trading is going to keep you poor, right? You have a better chance of winning the freaking lottery than making money on a consistent basis trading. It's true. It's facts. And then another study, the performance drag. This was done in 2000 by Barber and Odin. This graph visualized the annual underperformance relative to the market. The bar represents the size of the performance drag. The most active trader faced a massive 6% loss versus the market each year, right? Why trade? Just cut out the noise, right? Cut the BS out and just focused on your strategy, right? If your strategy is good, you've done the research, you've done the backup, you've understand what you're doing, you understand the study, you understand what you're doing. Ignore all the noise. Ignore all these articles just pumping out this stock that you hold is bad. This stock that you hold is good. This stock that you hold you got to sell. This stock is gonna 10x. This stock is gonna 5x. All these articles are being pumped out, so you can click it, you can pay for the subscription, you can pay the website, you can, it forces you to unlock all these extra features. And then the Delbar behavior gap 20-year data. This is I believe a another study done visualizing the 20-year 2005 to 2024 cost of behavior. An investor who did nothing more than hold the S&P 500 ended with almost $371,000 more than the average investor who reacted to media narratives, right? The more media, the more bad news you're going to keep taking it as bad news. And then it's just going to force you to be like, all right, maybe I should sell this stock and buy something else. And then it's just the whole cycle of repeating and repeating and repeating. The 20-year catastrophic, which is 52% of potential wealth destroyed. The guess right ratio is the Dalbar study found in investors guess right ratio timing market inflows outflows fell to a record low of 25% by reacting to media narratives. The average investor whipsawed by poor decisions destroyed more than half of their potential long-term wealth. Literally 50% of your wealth destroyed just because you were constantly like scrolling looking for news, trying to just, instead of actual doing like research, you're just listening to what other articles are saying about it and not and taking it for face value instead of actually digging deeper. Right? There's a huge difference in actually reading these articles and fact checking it and actually doing your own research to it. Okay, this article says something about this. Let me find the pro cons in the middle area of this article. A lot of people don't do that. A lot of people take the article as face value, like you're like listening to a YouTuber like me. Fact check me. Do your research, right? I put out videos. Do your research. I always say, let me know if I'm wrong. Let me know if you agree. You know, what do you think of it? What have you learned? What I should have learned, right? You gotta fact check it. Don't take it at face value. Don't just be like, oh yeah, he's right. Okay, you know what? I shouldn't own this stock, and then it 5x, 10x, or I told you to not own the stock, and it turns out to be good, but you didn't fact check me. It just happened to be a lucky guess, and a lot of people do that. The noise experience, a casual link to clouded judgment, which is basically the volatility amplifier, right? Two times higher return. A foundational noise study. Investors were split into two groups. The noise group, price plus news, which is for most modern investors, and then the price group, price only. In a high volatility test, the price group, no news, generated double the return. The news stream acted as a cognitive contamination, especially during market panics and euphoria. Mechanism of sabotage, behavioral biases on demand. Basically, this is like what you want to uh, what you want to listen to, and what you your own biases, what you want to hear. The platforms want to punch, right? I'm gonna start using examples. Recency bias, alerts, breaking news, ban. You see all, like every time you see, like everything is breaking news now, right? Everything is breaking news, even though it's not. But it's to catch your attention, it's to make you feel some type of way, and it's to make you kind of like, oh, I have to get on, I have to do something, I have to FOMO into something, right? It's it treats the information as it's the most important, overshadowing your long-term thesis. Right? It makes you change your psyche and your emotions. And then the confirmation bias, social platform like StockTwits, Seeking Alpha, the comment section are perfect echo chambers. If you guys haven't noticed, it's like all straight. If they hold the stock, if everyone holds the stock and that stock is about the article, it's just all good, 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 good. There's like no cons, right? That's the perfect echo chamber. And then when you go read the article, you scroll through the comment section, then you feel good about buying it or holding it. That does you no good. That does you nothing. That actually harms you. right? It reinforces your preconceived notions, prevent objective reevaluation, and cultivate overconfidence. The disposition effect, right? The bias, which we talked about, tendency to sell winning investment too early, to lock in a gain and hold losing investments for far too long, taking a loss. The platform trigger, this bias is magnified by, um, I think, UIs that predominantly display like unrealized gain, profit loss, often color screen red and green, making your purchase price the most silent data point, which is kind of like what Robinhood does. The cost. This single bias is so powerful that according to a 1998 study, it causes investor to achieve returns that are 4.4% points lower per year. Right? It's all about if you can get rid of your own biases. You have to look at everything um, pretty much from a middle standpoint. Asymmetric damage, and what this is just a study on IPOs found media sentiment had no impact on institutional pricing, but a strong positive impact on first day returns driven by retail investors are more easily influenced and abandon rational judgment, right? It's the FOMO. And the business of noise, right? How platforms systematically divert your thesis, right? The fundamental conflict. Your goal is always patience. The optimal strategy is long term. Always think long term. Low turnover, buy and hold. Wealth is built slowly and quietly. The platform goal, engagement. The business model relies on maximizing clicks. As you know, these articles they make money by maximizing clicks, page views, and subscription. Revenue is built on activity. The conflict, a successful passive long-term investor is the worst possible customer for a financial media platform. Understand that you guys are the product, right? What are they trying to do? They have to get you to agree with them. So they will write these articles about your stock, good or bad, and it will throw you off your game. Weaponized features, right? And just these are just some of the example like Zacks, right? They produce noise services, like headlines trader, surprise trader directly monetize noise group behavior, promoting a short-term casino-like mentality over a sound long-term thesis. Like another one like Seeking Alpha, right? Manufactured urgency, alerts create a first urgency, implying you must act today. The daily quant rating frames investing as a high frequency activity, encouraging constant checking and priming you for over trading. The investor's edge, right? A passive case for cover call ETF strategy. This would be how I feel like what you should do, what I would do, right? The disciplined cover call strategy. My thesis is generate a steady 7 to 10% yield from cover call premiums and manage volatility. This is a sound long-term income strategy, right? Build your core first, the 7 to 10%, and then scale up, right? And the defense, the noise, no media noise, like nav erosion distracts the true goal, sustainable distribution. A disciplined investor ignore this noise and focus on the cash flow, right? The discipline, which is the signal, instead of chasing shiny objects like hot stocks, the cover call investor like myself and you systematically harvest volatility, right? That's the signal as a source of premium, creating a reliable income stream, right? So we're okay with the ups and downs. As a matter of fact, we want the up and down. And then we come to the payoff, right? You avoid a behavioral gap by not overtrading. You beat the average investor by sticking to a rules-based system, letting the premiums compound and achieving your goal, your income-focused goal. The true advantage, right? 30% less drawdown, typical CC ETF versus the S&P 500. While the media obsess over capped upside. That's what we always hear, right, from these comment section about whoever is against a cover call ETS. Oh, cap upside, NAV erosion, right? They miss the point. Cover call strategy is not to beat the S&P 500 in a bull run, but to generate high income and lower volatility. Keep that in mind. That's your investment thesis, right? Find a good cover call ETFs that can generate high income, lower volatility, right? Somewhat match have a nice match with the drawdowns when it comes to a pullback, right? It doesn't have to do well on everything. As much as we would want to, there is no stock out there that does it all. It's not possible. Uh, right, then this would provide a smoother return and significant downside cushioning, as I mentioned, which is a winning formula for an income-focused investor. Right, keep that in mind. This channel, myself, and if you're watching, if you agree, we are income-focused investors. Ignore the noise from the peer growth, from the true fire movement, or whatever else. Right, the hype stock only, the meme stock. Oh, you ignore them. We are here for the income while having some good capital appreciation. We're okay, but we don't mind, and we would like to have lower volatility, but we don't mind if it shoots up and down. Right, we buy the dip. We hold quality cover call ETFs, and we buy the dip if that happens. Re-anchoring the cover call ETF thesis, right? Focus premium income. The true goal is generating a consistent high yield cash flow from option premiums, not beating the market. So if they keep saying, "Oh, you're gonna not beat the market," don't even respond. Who cares? That's not even our goal here. The signal volatility. The signals to harvest market volatility, high volatility, which is like, the media is panicking. Oh my God, the market is crashing. Market is crashing. Like today, right? Market is crashing. Market is crashing. The whole thing's gone red. Offering higher premium. Okay, we like that. We don't care, right? And us, the driver, we need the discipline. Your edge is the behavioral discipline to stick to the system. Disciplines means consistency. Consistency means generational wealth, right? That's what we're here for, right? Collect the premium and ignore the NAV fluctuations, right? As long as the NAV isn't plummeting consistently, it's fine. It's okay. We can buy the dip. We embrace the dip. All right, your discipline is your edge. All right, tune out the noise. Thank you. Questions? Leave a comment. Like, it helps my channel. Subscribe. I try to answer every single questions. I'm not biased at all. I will probably never ever get sponsored by Seeking Alpha. Right? I'm not a huge fan of them. So I try to be as partial as possible. I try to be as fair as possible. I don't ever put my stocks over anybody else because, hey, I might be wrong, you might be right, right? I learn just as much as you guys learn from this video and channel, which I hope. I try to make this as educational as possible. I use at least 20, 25, 30, maybe even more, depending on the video, the sources. And then I just pretty much, I compare the sources. I put all the details together, and I try to fact check it. And if anything's wrong, if anything needs to be fact checked, let me know. I hope this video has helped you a little bit. When I started out investing, I did not ignore the noise, and so it made me a worse investor. And when I started to tune out the noise, and when I realized it was all BS, right, I became a better investor. I stuck to the facts. I stuck to understanding what I bought, what I hold, and I embraced the red days. I embraced the 1 to 3% downs. I love a 5% down. Give me a 10-15%. I buy. I don't care. I will buy. I know I hold quality, superior cover call ETFs, and I will spend cash. And when that day comes, you guys will probably see me post on my YouTube channel. I bought 40, 50, $60,000 worth of whatever, right? Thanks for watching, guys. Stay tuned. See you guys on the next.